The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Thank you for joining our webinar today for the investment update. Throughout this webinar, we hope to increase your understanding of what's been occurring in the markets and the economy recently. We'll cover a variety of topics, including interest rates, the state of the economy, and political policies that we're watching. I'm Angela Palacios, the Center's Director of Investments, and joining me on the call today is Maria Quinn from Vanguard. She's an advisor, education specialist who specializes in presenting Vanguard analysis and research, and we're lucky to have her with us today. Before we get started and we dive right into the presentation, I'd like to note that this webinar is not open for questions in real time. However, if you do have questions, please email me directly following the webinar, and I'll be happy to respond. You can also visit our website for more information and upcoming webinars. Now I'd like to hand it over to Maria to dive right in, as we have a lot to cover today.
All right, thank you so much, and thank you everyone for joining us on the call this afternoon. My name is Maria Quinn, and I am an advisor education specialist with the Vanguard Group. Primarily speak to advisors, but often enjoy the opportunity to connect with clients and share with you some of the insights that we have into the financial markets and also into the global economy. I will spend about 25 minutes or so kind of reviewing our look on the market, kind of some updates from fourth quarter of last year, and where we see the market progressing and the economy progressing on a global scale in the near term and more on the intermediate to long term range. So really looking at 10 years or so. In terms of our approach, we do believe in treating the future with the deference that it deserves. So we believe that market forecasts really are best viewed more in a probabilistic framework. So we provide ranges of returns and outcomes that we then believe inform strategic asset allocation decisions. And you'll see that over the course of the content this afternoon. As I mentioned, I'll begin with an overview of what we saw coming in fourth quarter, which interestingly enough probably took many economists and many policymakers and many within financial services a little bit by surprise, as it was not entirely anticipated at the end of third quarter. We saw that the global markets really ended on a positive note, but it was a bit of a choppy end of the year over those final 3 months. And as you can see reflected in those bar charts at the bottom, in terms of the global market returns for December 31st of 2016. In the blue, we take a look at the quarter itself, so fourth quarter, represented in that navy color. In that lime green color, we take a look at 2016 in its total. And what we found in the equity market is that the U.S. equity space really did rally. It was much higher than the growth forecast suggested, following the U.S. presidential election that occurred in November. And we can see that reflected in that 4.1 number there. So the final 3 months, that growth of 4.1% in the U.S. stock market. The year itself in the U.S. stock market ended at 12.7. Now when we take a look to the international market, so the non-U.S. stock market, we really just see that the equity space there lagged, underperforming on the quarter, negative 1.3, but it was positive overall for the year at 4.7. Global fixed income did post negative returns in the fourth quarter. That was really due to the yields rising on higher growth and inflation expectations coming globally. But we did notice that domestically as well. When you take a look at the 3-month returns on the U.S. bond market, at a negative 3.1%, this in that center area for fixed income. But again, overall positive on the year at 2.8% for the full 12 months. Non-U.S. bonds, so non-U.S. bonds hedged back to the dollar, on that 3-month scale underperforming at -2%, but on the year end in total with a 4.9% return. And then our short-term tip space underperforming just under a percentage point, so 0.2% there, but again, positive on the year end at 2.8. Balanced portfolios implications, when we take a look at a balanced portfolio in a 65-35 diversified portfolio, this would be constructed between broad equity exposure and then also investment grade bonds. You're seeing a overall year end up 7.4%, but again, given the fixed income or exposure there to the portfolio, really minimal returns for the quarter at just 0.3%. Following the election, so taking a little bit more of a deep dive into the U.S. equity space, really the most favorable and the strongest returns at the end of 2016 was in the small cap section of the market, segment of the market, apologies. And all market caps did relatively well, but you can see in small cap just in the final 3 months of the year, outperformance by that 6.1%, ending the year up 18.3%. Large cap, for example, on the quarter at 3.7, but for the year at 11.7. We did note that the U.S. Value stocks really continue to outperform. So when we take a look at growth versus value, really thinking here your more traditional defensive sectors, they were outperforming significantly compared to the growth sectors there, up 7.2% for the quarter, 18.4% for the year. Whereas growth was just at 1.2% for the quarter and 7.4% for the year. In looking at non-U.S. equities, developed markets were relatively low in performance, actually were negative on the quarter, just down nearly a percentage point, but overall were positive on the year at 3.1. One of the more interesting stories probably to develop out of 2016 was emerging market performance. So while down 2.8% at for the quarter, we did note that they were up 13.2% for the year. That was largely due to commodities and to also the energy sector there. They really did promote a strong rally in the emerging markets. In terms of sector performance, as I had alluded to just on the prior slide, value sectors did lead for the quarter and also for the year. As you can see, that 10 of the 11 sectors posted positive returns over the 12 months. Other than healthcare. Healthcare was negative both on the quarter and for the year, down 4.3% for the quarter and down overall 3.2% on the year. The value-oriented stocks carried the vast majority of the growth that we're seeing here in terms of the performance. So financials leading on the quarter at 20.5%, overall for the year at 22.5%, but really the overall performance on the year, the energy sector, telecom sector, and financial sector really promoting the returns there. Growth-oriented sectors, again, healthcare, information tech, they were lagging on the quarter end and also for the year. When we take a look at fixed income for 2016, we do see that what we had observed to be a bond rally came to an end at the end of the year, with both U.S. investment grade bonds and corporates really starting to take on some negative returns there. We only really experienced positive returns in the high yield fixed income space for the end of the quarter. As you can see there, at 1.8% in high yield was the only positive performer within the credit exposure on the U.S. fixed income side. On the year ending up 17.1%. Investment grade corporates did end positive at 5.6%. So while we're overall a little bit more of a positive story in fixed income, again, the greatest returns coming in the high yield space. Taking a look at maturities, again, almost across all of the maturities, you've about a 1.0 to 1.3% return there. Whereas on the quarter it was a little bit of a rocky ride through the end of 2016. International fixed income, again, down on the quarter across bonds that are both hedged to the dollar and not hedged to the dollar. When we take a look at the international fixed income that is hedged, a little less of a negative return there, only down 2% on the quarter, but up 4.9%, so nearly 5% on the year. It was in the international bonds that are not hedged to the dollar, so perform much more in line or more highly correlated to equity positions. Traditionally, they were down 10.3% on the quarter, 1.5% for the year. In terms of the Treasury yield curve, following the election in November, we saw that the yield started to move higher along the curve. Reflected on the chart, you see current yield through the end of 2016 in that blue color. We compare it to the, in the lime green color, the yield at the end of the quarter, at the end of third quarter, so ending on September 30th of 2016. You do see the movement upwards, but when we take a look historically at comparison, for example, comparing the year of 2016 also to the year of 2015 reflected in that gray color, performing much more in line, or the yield curve approaching much more in line on the long end of the spectrum with the 2015 projections there. In terms of market cyclicality and leadership changes for the various asset classes that were performing in fairly different ways over the course of 2016, when taking a look just across the top line of this chart, and I do realize it's a little bit busy for you, I call it my periodic table and also my jelly bean chart. I've also heard it referred to as quilt charts. But essentially what we're doing is we're ranking the various asset classes against each other for any given performance year from 2007 to 2016. So what we found is that over the last decade, there has been a lot of fluctuation in who's kind of holding that winner spot along the top. As you can see, in 2007, emerging markets appeared at the top, but then immediately in 2008, it appeared at the bottom. And while emerging markets has been a pretty positive story for at least 2016, it kind of falls into the middle of the pack there. It's that bright lime greenish color, almost, I guess, pea soup color in some ways, in the middle there, just above the REIT exposure. Speaks to the benefits of a diversified and balanced portfolio. What we find is that generally a balanced portfolio winds up a little bit more to the middle. So not necessarily performing at the top all the time, not performing at the bottom, but giving you kind of that more muted, more palatable ride, as it were, with smoothing out some of that volatility in the upward or the downward space. In 2016, it was a bit of a continuation of the story for the headwinds for active management. And what we found is that just generally taking a look at actively managed funds that were not only surviving over the course of 2000 to 2014, but also outperforming, it was a difficult supposition to continue to not only outperform the market, but also in terms of survivorship bias. What we found is that over that 15-year time frame, about 1/4 of active funds did survive and outperform, and that 98% of those that did survive and outperformed actually underperformed in at least 4 of the calendar years of that 15-year time frame. The percentage of actively managed funds that outperformed their stated benchmark, we noticed that cost did play a tremendous effect or impact there. When looking at the lower left-hand side of the screen, we are comparing 2 quartiles here. In the blue, we compare the most expensive quartile, and then in that lime green, we compare the least expensive quartile on the 10, 15, 20, and 25-year range. And what we find here is that cost does become very important in the selection of active management, with the least expensive quartile outperforming for all 4 of those year ranges, and then the most expensive quartile underperforming or relatively underperforming there. It's funny, I mentioned this in earlier remarks today, but we had the opportunity for our managing director of our Advisor Services division to present at Insight ETF in January, and it's been written about pretty extensively, but he opened up his keynote remarks with talking about whether or not it was the death of active management. Very sensational. I think it was a lot to kind of bring people into the room and listen to remarks on where we think active management is going. But while he does not believe that it is in any way dying, it is evolving. And there are ways in which you can maximize or achieve greater level of success with active management. And that new active management really does take a look at talent, patience, and then also factoring in cost. So finding active managers that you have conviction in, where you understand the people, the philosophy, and the process, but also having the patience to hold on to that particular investment to fully realize its performance benefits, so sticking to it for the long term. And then also with cost. So cost being one element that we can control for with looking for low cost, high quality products, potentially having a greater potential for return over the long run. Now to take a quick look at our thoughts on the economy and our outlook. This is just be a very high level slide for you. In terms of growth, we do believe that globally we will see growth stabilize, but at a much lower trend than it has done so in recent past. We do not believe that this is stagnation. So stagnation would be negligible or no growth. You'll find that in an environment where you see that income is relatively high, but savings has increased and investment, so capital investment or even individual investing, has decreased. That generally will put an economy in a perpetual cycle of a standstill growth, as it were, and that's really what we refer to as stagnation, or sometimes you hear it called secular stagnation. And we do not believe that to be the case. We do believe that there is still growth and potential for growth, but it is going to be much more stable, much more muted in terms of our expectations. And that is a reflection of a number of fundamentals. There are technological effects, demographic effects, and globalization effects that are coming to bear. Technology, just being so prolific, it's made as a consumer, it's become very, very cost competitive, and it's driving so much of industry now. But as starting an organization, a corporation, it can create a pretty high barrier to entry, just in terms of the cost there. Demographics, we're looking at a shift within the demographics, both domestically and abroad. The aging of the baby boomer population, we have less people in the workforce, or will be aging out of the workforce, drawing on various things such as Social Security, et cetera, that will have an impact just on our demographics. And then globalization always coming to bear with the markets ever expanding and growing in efficiency. In terms of inflation, we do see a tightening in the labor market, in particular in the United States. We anticipate that U.S. core inflation could exceed the 2% target, but modestly so if it does. When we take a look more broadly, we'll find that central banks will continue to struggle to meet that targeted 2% inflation. For policy and interest rates, we do anticipate that the low yield environment is here to stay, so it is not temporary. It is very much becoming a secular element. And we'll note that particularly in Europe and in Japan, while they are still in very low rate environments, we don't anticipate that they will raise rates as we're starting to see in the U.S. And they may not raise rates this decade, but we will find some elements of their monetary policy kind of coming to their limits there. For global asset returns, we have a very guarded view, just given the cross-current of the low yield environment that we're in, and also very relatively or historically high equity valuations. For a 60-40 portfolio, for example, so a balanced portfolio, both having exposure internationally and domestically on the equity side, and internationally and domestically in the fixed income side, so very broadly diversified portfolio. Looking at a return expectation of about 3 to 5% for the next 10 years. Then that'll be below the historical average of 6%. We'll dive a little bit more into the themes that we are seeing for 2017. And I realize there's an awful lot on this slide, but the way in which I'll kind of tackle it is looking at the global themes that we're seeing emerging, the themes domestically in the United States, the themes in Europe, and then ending on the themes in Asia, and then talk about the implications for asset returns within portfolios at a global level. In terms of growth globally, we do believe, or we expect, I should say, a real global economic growth of about 3%. Now that will be stable growth, and it will continue amid any of the geopolitical uncertainties that we're observing at the moment. So slow productivity growth given the various headwinds that we've discussed. In terms of inflation, we will find that a number of the developed economies are going to struggle to consistently target or achieve that stated target of 2% core inflation, mostly because of depressed inflation expectations. We will see various implications for that as I talk about Europe and Asia, though, very shortly. And we will also see some potential pernicious deflationary forces that are cyclically moderating. So we might see some deflationary forces coming as well. For monetary policy and interest rates at a global scale, global bond yields are unlikely to rise materially until productivity growth accelerates globally, though some structural forces could nudge rates higher over a period of years. Now, when we take a look at our outlook, we are really looking at a 10-year time frame of probabilities here. So nothing necessarily short-term. We're not trying to give you a snapshot view, but really where we think we see things going, both in the intermediate and long term. For the United States, the U.S. economy remains firmly on a long-term growth path of about 2% a year. So such slow growth actually should be viewed as being fundamentally sound rather than abnormally low. After accounting for population growth and consumer debt-fueled boosts to growth between 1980 and the global financial crisis. So we do believe that it is not low, but it is fundamentally sound. In terms of core inflation, as I had mentioned, we should modestly exceed 2% in 2017, which will have implications on our monetary policy and interest rates, likely prompting the Fed to lift rates. We will see with the productivity rise, we anticipate that we will see a wage increase as well, and wages may rise 3% in 2017, slightly ahead of the rate of inflation. So that's good news on the wage front. For monetary policy and interest rates, what we expect is the Federal Reserve to continue what we refer to as a dovish tightening, so slowly and very in measured amounts increasing their rates over the course of the year. Anticipate that as we see them lifting, its target for the short-term rates could potentially reach 1.5% in 2017, but that does remain to be seen, and that the U.S. monetary policy will remain expansionary even as those rates do rise. Europe, we do expect that with Brexit occurring in June of 2016, that we will continue to kind of bear the Brexit brunt, as it were. I've seen articles refer to 2017 as year one AB, year one after Brexit, and we do think that there will be significant implications for whether or not we see a soft Brexit or a hard Brexit. A soft Brexit meaning that while the UK will no longer be a part of the European Union, it will still be a part of the one market of Europe. That would be the ideal kind of scenario. Should that not be the case, if there is a hard Brexit where the UK has to renegotiate all of its trade agreements, immigration policies, etc., that's where we're more likely to see Brexit occur in that hard Brexit range. That will have an impact on the economic output of the UK, and we do believe that it will be down by 2 to 3 percentage points in the short term. For the rest of the Euro area, we do anticipate 2017 growth to be about 1.5%. In terms of inflation, we do think that the core inflation of the EU will fall short of its stated target. So the European Central Bank, the ECB, has a stated target of 2%. We do believe that it will fall short of that in the next 3 years. For the UK, given the depreciation of the British pound sterling, due to Brexit occurring, we believe that they will exceed their inflation expectation. Monetary policy across Europe, high European unemployment and low capacity utilization suggest an opportunity to remain for aggressive stimulus to awaken the economy from its kind of cyclical slumber as it exists, but it remains to be seen whether or not they will seek to implement that. The European Central Bank, though, has announced plans to continue asset purchases through the end of 2017, but at a reduced amount, so some reduction there. When we take a look at Asia, in Asia we really do focus on probably the two largest economies being China and Japan. And with China, we do not expect to observe kind of the 8 to 9% growth targets that they had in the past. They've actually reduced those targets for 2017. And we expect a real feel for Chinese economic growth at about 5%. Less than the rates at which it had been growing in years past, but we're actually very optimistic, or cautiously optimistic, I should actually say, that over the medium term that there is a stronger likelihood that China will avoid a hard landing scenario. So kind of avoid that significant economic impact if their economy grows at a slower rate. Due to a number of reasons, China does have a number of reforms that it needs to implement, both in terms of its economy and also in terms of its social structures, so in terms of protecting its working class. And we believe that those reforms and structures will be put in place in advance of this potential hard landing scenario to evolve. Japan's economy is likely to grow this year at 0.7%. That's actually modestly above its long-term trend of just 0.4%. In terms of inflation in Japan, we believe that the inflation could recover gradually towards 1%. And in terms of inflation in China, as I'd mentioned, China's really at a crossroads and has to balance its near-term economic considerations and its social stability against its long-term growth sustainability plans and keeping financial risk at bay. So we may start to see some reforms and policy changes, but nothing that would at this stage indicate what their target might be for inflation. In monetary policy, given the reduced growth, which in China, despite it moving from an 8-9% annual growth to a 5% growth, it is a stable growth. So while that growth is less than it has been in years past, we believe it's unlikely that China will implement any large-scale stimulus plan for 2017. Bank of Japan introduced a negative rate policy in 2016 and is likely to modestly expand its risky asset purchases. So we may start to see some expansionary process in their monetary policy in 2017. But further rate cuts, so further reducing their rates, is unlikely for the year. In terms of our market outlook regarding portfolios, what we believe is it's muted but positive despite the low rate reality in which we exist. Over the coming decade in a balanced portfolio, the inflation-adjusted returns of the portfolio is likely to be moderately lower than historical averages. So as I mentioned before, about that 3 to 5% on a 60-40 portfolio over the 10 years ending in 2026. And that's down historically from the approximate 6% that we've seen in years past. In terms of stocks, stock valuations are elevated by historical norms, and we believe that's likely driven by premiums, the premiums are likely explained by interest rate and inflation rate expectations there, which are low by historical norms. The outlook for our global stocks is guarded, but by no means bearish. We believe that the annualized nominal returns over the next 10 years for global stocks will be about 5 to 8%, with a real return feel closer to that 5% when adjusting for inflation in the portfolio. In bonds, we do not perceive there to be a bubble in U.S. Treasury securities, and our estimates for the fair value yield of the 10-year Treasury note are about 2.5%, in line with market levels at the time that we published our paper in December. And we believe that bond returns are likely to be positive, but they will be muted. Here we take a look at projected global equity and our 10-year return outlook. The VCMM that you see represented there is our Vanguard Capital Markets model. Essentially, it's a model that runs what we refer to as a Monte Carlo simulation, where they take a look at 10,000 various probabilities, and at the end we create a result where we align them according to 1 percentile to 99 percentile in terms of the likelihood of occurring. And what we do is we parse out that median range, so those two center, or the 25 to 75% range, take the median of that, and that's generally where our probabilistic framework lies. And so when we take a look at the expected average annualized nominal return of a global equity market, and this is as of June of 2010 reflected in the lime green, and our current outlook reflected in the blue, what we find is that our current outlook for the global equity space is about 4 to 8%. Now, if we compare that to the lime green, where our outlook was in June of 2010, it was at 8 to 12%. So again, it is muted, but it is still positive. You'll find it's pretty similar here with our projected global fixed income 10-year return outlook. Again, in the navy reflecting our current outlook, and then that lime green reflecting the June 2010 outlook. Really, we're looking at the projection of the 1.5% to 2%, whereas in June of 2010, we were looking at 3 to 3.5%. Still positive, but again, muted. Here we take a look at global asset returns. Again, that idea of a guarded view, given kind of the cross currents we're seeing both for yields and the higher equity valuations. On the left-hand side in that chart, we're looking at 3 different portfolios. In the Navy, we're looking at a 2080 portfolio. In the lime green, a 60-40. And then in that grayish color, an 80-20 portfolio, each realizing a 10-year annualized return, looking historically at the performance from 1935 to the end of 2015. You do see convergence of portfolio performance kind of as we get towards 2015, but obviously marked volatility depending on the asset allocation over the course of the years. Argument here for maintaining diversification, and appropriate risk tolerance of a portfolio, because that historical performance is not going to be indicative of our future forecast. On the right-hand side, we do have our futures forecast, and this is projected returns, and they will be moderately below historical averages. So reflected in that blue bar, you will see the projected returns for a 2080 portfolio. Now this looking forward over 10 years. And that 2080 portfolio, the median range there being at 1.5%. In that lime green, you'll see the 60-40 portfolio, the 60-40 portfolio median at 3.8%. And in that gray bar all the way on the right-hand side, our 80-20 portfolio with the median at 4.8% there. Of course, with a range, just depending on the probabilities and where they factor. But looking at that median percentile, they will see that the expectation much more below that historical average. The historical average is captured in those circles, so that kind of gray, light gray circle that you'll see. In the 2080 portfolio, it's above the portfolio. In the 60-40 portfolio, it's kind of just at the top of that median range. And then in the 80-20 portfolio, it sits just in the center of that top box there. So that's where we're seeing the historical averages and the anticipated averages being below that. And with that, I will turn it over to Angie.
Thanks, Maria. That's a lot of great information. So one of my challenges as part of the investment committee here at the center is to distill all of that great information down into executable ideas that we can really incorporate into portfolios. I'd like to take you through some of what we're thinking about in the investment committee at the center and how what's coming could potentially affect your goals and your portfolios. So first of all, let's take a look at different markets and how they perform each year in relation to each other. If you look at this chart, you can see specifically how other markets that could be part of a diversified portfolio like high yield, REITs, global equities, And you can see how they performed in relation to the S&P 500. So the S&P 500 is the black line that you see going across this chart. And each of the asset classes listed are stacked either above or below the S&P 500 as either outperforming if they're above in that calendar year or underperforming for the calendar year. As you can see in this chart, the S&P 500 has been the index to try to beat and hasn't been beaten by even the most aggressive asset classes in the last few years. What I want you to understand, though, is that this isn't normal. If you look back over the past 20 years, the S&P has been eclipsed by many different asset classes depending on the year you look at. So what this really means is that diversification over those long periods of time worked, but it hasn't felt like it's worked very well in the last few years because U.S. large cap stocks have dominated so handily. But what I want you to understand is that diversification isn't necessarily meant to work every time. It's meant to work over time. And at the center, we're designing portfolios that keep you on your way to meeting your goals. And the way we do that is through diversification. So what are we thinking about right now for portfolios? Well, obviously, policy change has been at the front of our minds with the new Trump administration. But a lot of it's just conjecture right now. It's kind of our job to sift through a lot of the noise that's coming out in the press and figure out what kind of impact that this could have on your investments. So this is a list of many items of potential changes that the President has talked about as being on his agenda to address. So we'll be taking these decisions kind of one by one and digesting and interpreting them in our investment committee. Looking at this list, there are a few that we see right now that could potentially impact portfolios more than others. Personal tax reform is a topic that our financial planning department, for example, is watching very closely. And changes here could affect the recommendations that we're making to you from a financial planning perspective. Investments could be really heavily impacted by a couple of other items, though, like trade or corporate tax reform. So first, let's talk about trade a little bit. I think this could have some of the biggest potential consequences to investments. President Trump is talking about adding maybe a tariff or a value-added tax system or a border-added tax system on all imports coming into the country. And that could increase the price of goods that we consume every day. So that could cause some potential inflation here at home. Also, it could cause retaliatory tariffs by other countries as to be charged on the goods that we export to them. So that means our goods at home could be becoming more expensive to us, as well as our goods becoming more expensive to other countries, and that could cause them to purchase less. And it could kind of turn into this cycle of higher prices, but lower number of goods being demanded, affecting the build rates at our corporations, affecting sales, affecting jobs. So regardless of what type of tax or tariff is implemented, it would likely have a negative effect immediately on international companies. But also later on, it could end up affecting domestic companies, even though that's who the President is expressly trying to help with this type of system. So while we hope these policies aren't implemented, we are watching for them at this point in time. Another way that Trump could try to help U.S. companies is by reducing the corporate tax rate. Right now, the U.S. has the second highest corporate tax rate in the world. Over the past 20 years, corporate tax rates around the world have come down quite a bit, while ours have actually stayed the same, resulting in our goods becoming less competitive, production moving out of the country, that type of thing. There are a couple of ideas being floated right now. House GOP is proposing dropping corporate tax rates down to 25%, while Trump is proposing an even more drastic cut down to 15%. So either of these changes would be positive for corporations here in the U.S., potentially boosting performance of their stock prices, or increasing the amount of dividends they pay back to their investors. But it also could increase inflation, and potentially that could lead to higher interest rates, strengthen the dollar down the road. This policy would favor U.S. stocks over bonds in our minds, and as well as U.S. stocks over foreign stocks. With all that being said, there are so many moving variables at this point in time. We don't know how other countries are going to choose to respond, and a lot of the results here depend on their decisions that they make. In most cases, it makes sense to stay invested and just stay diversified. So right now, we're neutral in all of our equity allocations. We haven't chosen to overweight or underweight any particular area at this point in time. I'd like to shift our discussion now around interest rates and just take a look at kind of where interest rates are and where they've been recently. If you look at this chart, you can see last year approximately more than 1/5. So right now 1/5 of sovereign debt, so debt issued by governments, is yielding negative interest rates. And that's down actually over 30% from last July. Through all of this, the U.S. is still kind of the most popular kid on the block with really attractive rates compared to other government debt around the world. We're that dark blue line up there on top. If you look to the far right of this chart as well, you see that rates have risen in the last quarter last year, even since mid last year. And you may have noticed this in your bond portfolios. Maria talked earlier about some negative performance in those bond portfolios. Because when rates go up, the prices of your bonds go down. But what you have to remember is that the information in this chart only represents government debt. That's not the only type of bond you can own for diversification effects. At the center, we look at managers that kind of look far beyond that, just that market for diversification purposes. So we have kind of a pop quiz. I don't know if you to answer this, the answer may be a little bit of a surprise, but last year were yields on corporate bonds, did they increase faster than U.S. Treasuries, do you think? But the answer may surprise you. Treasury rates have come up actually much faster than corporate debt. And active management in your bond portfolios is extremely important going forward as the trend of rising rates continues, even though it may be slow. We do think it will continue kind of in fits and starts. But you have to understand that there are areas of the bond market that you can still achieve decent performance out of, and we don't want to abandon bonds altogether just because interest rates are going to go up. They are still a very important part of a diversified portfolio, and that piece of the pie that tends to perform well when stock markets hit rough roads. So the last point I'd like to go into on interest rates is wage growth. Wage growth is still well below what the Federal Reserve wants to see. You may ask, why is this important? It's important because it's a leading indicator to inflation. Without wage growth at certain levels, it's hard for the economy as a whole to experience inflation. And without inflation, the Fed is unlikely to raise rates, maybe even at the pace that they've anticipated. So if you look at this slide, you can see that gray line going across at 3.5%. That's what the Federal Reserve is targeting wage growth at. That's what they want to see. And you can see we haven't been there in a very long time. Since 2009, I think, was the last time we saw that type of wage growth. So a change of inflation could be driven as that wage growth approaches that 3.5% line. You can see it has picked up and it's getting closer, but it's still well below what the Federal Reserve wants to see for setting policy. So I'd like to conclude with just a reminder that markets are up, and we've enjoyed many years now of positive returns. I think it's important to remember what we can do when markets are up. It's not a time to become complacent with your investments or your financial planning, as many people do. We want to make sure we're always focusing on having those cash needs that are planned for in cash. if you know you're going to be withdrawing money over the next 12 months, let's have it in cash. Let's not have it in the market subject to any type of negative potential return stream. We also want to make sure we're rebalancing our portfolios, and that's something that we monitor for you at the center for our clients. It's a good time when markets are up to take advantage of making our charitable contributions. You get that nice tax benefit from making those contributions to your favorite charities. So why not do it with appreciated stock or exchange-traded funds or mutual funds from your portfolio and get the added benefit of being able to move those capital gains out of your portfolio without having to pay taxes on them, in addition to getting the potential tax write-off for the charitable contribution. Last but not least, don't ditch the plan. Make sure you're meeting with us on a regular basis, thinking about your financial planning, your progress towards your goals. It's important to always stay on top of that in good times and in bad. And with that, since we won't be able to take any questions today, I'd like to direct you to my email on the screen. If you have any questions, don't hesitate to reach out. I'd be happy to talk with anyone. And also, we will be emailing out to you a link so that you can listen to a replay of this webinar. And you can also go to our website to see upcoming webinars as well as any blogs that we've been writing lately and commentaries. Thank you very much.